Have you ever found yourself just wading through tons of information trying to make like one really smart choice?
Hmm.
Especially when it's about your money. It can feel a bit much sometimes, right? Well, today we're going to try and cut through some of that noise, give you some clarity on a pretty key investment decision. We're doing a deep dive into the world of exchange traded funds. ETFs specifically, we're zoning in on two really popular global ones. They both track the same thing, the FTSE All World Index. We're talking about the Vanguard FTSE All World UCITS ETF, that's VWCE or VWRA, and the Invesco FTSE All World UCITS ETF, which is FWRA. So our mission really is to pull back the curtain on how these funds actually perform, going beyond just the advertised fees. We want to unpack things like tracking performance and tracking difference. These metrics help you understand the real costs and maybe the real benefits too. And we've pulled this together from the official fund fact sheets from Vanguard and Invesco, but also from a really interesting online chat we saw where investors were comparing these exact funds. We'll synthesize all that for you. Okay, so to really get this, maybe we should quickly get the basics down first. What exactly is an ETF and what's this FTSE All World Index they're both trying to copy?
Right. Okay. So an ETF, an exchange-traded fund, it's basically a bundle of investments, stocks, bonds, whatever, that trades on a stock exchange, just like a single stock. You can buy and sell it all day long. And these two funds we're talking about, they're UCITS compliant. That's a European standard, basically, for investor protection. And the core idea behind them is passive management. They're not trying to be clever and beat the market. They're just trying to mirror an index as closely as possible. And that index is the FTSE All World. What's important here is just how broad it is. It captures large and mid-sized companies from all over the globe, developed markets, emerging markets, the lot. It's weighted by market cap, so the bigger companies have more influence. And crucially, it doesn't lean towards any specific country or industry. It gets rebalanced twice a year to keep it up to date.
Okay, so they're built to give you this really wide slice of the global market. Sounds great. But investing always has risks, right? What are the main things you need to be aware of here?
Yeah, good question. It's absolutely crucial to remember that investments can go down as well as up. The value, any income, it can fall. You could get back less than you put in. And because these are global funds, currency swings can affect your returns too. Then there are other risks, like liquidity risk, maybe not being able to sell easily if there aren't many buyers. Counterparty risk too, if the service provider fails. And importantly for these, index tracking risk. The fund isn't going to track the index perfectly like second by second. The aim is just to generally match the price and yield performance, before they take out their expenses. And always remember, past performance doesn't tell you what's coming next.
Got it. So with that background, let's meet our two main players, VWCE from Vanguard and FWRA from Invesco. You mentioned both are accumulating funds, so dividends get automatically reinvested, which is great for compounding over the long term. Let's look at the stats as of May 31st, 2025.
Okay, so VWCE, the Vanguard one, it's been around a bit longer, launched July 2019. And it's huge. Nearly $40 billion in total assets. The specific share class we're looking at has over $21 billion. Its ongoing charge, the OCF, is 0.22% per year. Then you got FWRA, the Invesco fund, much newer, launched June 2023. It's way smaller, about $1.64 billion in size. And its NAV per share was about $7.19 then. The thing that jumps out with FWRA is its lower ongoing charge, 0.15% per year. Both based in Ireland, both use physical replication, meaning they actually buy and hold the stocks in the index.
Okay, so we've got the older, bigger fund, slightly higher fee, and the newer, smaller fund with the lower fee. And it's interesting, both hold a lot of U.S. stocks, right? Around 62% each. And their top holdings look pretty much the same. Microsoft, NVIDIA, Apple leading the charge.
Yeah, it really is striking how similar their actual holdings are despite the differences in scale and age. It shows they're both sticking close to that FTSE All-World benchmark. That 0.07% difference in the OCF, that's often the first thing people focus on, isn't it?
It usually is, yeah. But this is where it gets really interesting. We often fixate on that OCF, but the investor discussion we looked at really emphasized something else, the tracking difference.
Yeah.
It suggests this might be the real cost. So what exactly is tracking difference, and why should you, the investor, pay attention to it?
Right. Tracking difference is, it's exactly what it sounds like. It's the gap between how the fund performed and how the index it's tracking performed. For passive funds like these, you ideally want that difference to be tiny, as close to zero as possible. Could be slightly positive, could be slightly negative. A smaller tracking difference usually means the fund is doing a better job of sticking to its promise, makes it more predictable. And yeah, the discussion really highlighted that the OCF isn't the full picture of the cost.
Okay, let's look at VWCE first then. The discussion mentioned its average tracking difference is minus 0.015%. And in 2024, it was just 0.01%. They basically said VWCE is doing its job almost perfectly, that its real cost is way lower than the advertised 0.22 per 2%, sometimes practically zero, like the fee almost disappears in practice.
Exactly. That tiny, sometimes slightly negative tracking difference shows it's hugging the index incredibly tightly. That's exactly what you want from a passive fund, that consistency. It points to really efficient management behind the scenes.
Okay, now for FWRA, the new kid on the block. Its average tracking difference was quoted as 0.36% and 0.34% in 2024. So the discussion pointed out that FWRA didn't just cover its costs, it actually beat the index, which sounds great, right? Outperformance. But it does raise a bit of a philosophical question, doesn't it? If a fund is consistently beating its benchmark, how purely passive is it?
That's a really good point. Outperformance is attractive, but yeah, it suggests maybe something else is going on besides just simple tracking. And the investor chat really dug into one key reason for this difference: U.S. dividend withholding tax, WHT. It's a bit technical, but really important here. You see, the FTSE All-World Index itself, the benchmark, is often calculated assuming a 30% tax is withheld on dividends from U.S. companies.
Ah, okay. But hang on, you said both VWCE and FWRA are based in Ireland. How does that Irish domicile change things for the WHT?
That's the crucial twist. Because they're Irish UCI's funds, they benefit from a tax treaty between Ireland and the U.S. They only pay 15% withholding tax on U.S. dividends, not 30%. Now think about it. If the index assumes 30% tax, but the fund only pays 15%, that 15% difference is like a built-in advantage for the fund. Even before you factor in the fund's own fees, that tax difference alone should theoretically let the fund outperform the index. If, say, U.S. stocks make up 60% of the fund and yield 1.5%, that tax saving could add, I don't know, maybe 0.135% to performance.
Right, okay, I think I get it. So let's apply that to VWCE. It has the 15% tax advantage, but its OCF is higher, 0.22%. So does that fee basically eat up the tax benefit, explaining why its tracking difference is so close to zero?
That seems to be the case, yes. The 0.22% fee largely cancels out the potential gain from the lower WHT, resulting in that very tight tracking relative to the 30% WHT index. Consistent, but no major outperformance from the tax angle.
But then for FWRA, with its lower 0.15% OCF,
Exactly. The argument in the discussion was that the lower fee means FWRA doesn't just offset its costs, it actually gets to keep more of that 15% tax advantage. That tax efficiency seems to be a major reason why it showed that outperformance against the 30% WHT index calculation. Plus, maybe some extra income from things like securities lending could be playing a part too.
Okay, this brings us right back to the investor, doesn't it? How do you use all this information, the tracking difference, the tax impact, to actually make a choice? The investors online were clearly debating this.
They really were. It boils down to a core dilemma, I think. Do you go for the fund with this super tight tracking difference, like VWCE, knowing it means staying incredibly close to the index, even if that means maybe slightly underperforming on a purely tax-adjusted basis, maximum predictability? Or do you chase that outperformance scene with FWRA, driven largely by tax efficiency and maybe lending, even if it means a slight deviation from pure simple index mirroring?
And that FWRA outperformance, you mentioned it's only got data for 2024 really. People were asking, is this just a one-off, a lucky year for a new fund? Or can it keep doing that? It feels like a bit of a gamble maybe.
It's definitely seen as a calculated risk by some in that discussion. You're right, the track record is short. And that's where other factors come in. VWCE isn't just older, it's massively larger, remember, nearly 40 billion AUM versus 1.6 billion. It also holds more individual stocks over 3,600 compared to FWRA's 2,400 or so. That size, that longer history since 2019, it gives investors more data, maybe more confidence in its stability and predictability over the long haul, even if the recent performance wasn't quite as eye-catching.
Yeah, that makes sense. But despite all that the history of VWCE, the discussion showed a lot of people are actually switching to FWRA. They're drawn in by that lower fee and, well, the numbers showing it beat the index. It just shows how tough these choices can be, right? You're balancing predictability versus potential extra gains, long track record versus lower costs, especially when tax gets involved. It's complex.
It really is.
Yeah.
But, one of the strongest takeaways from reading through those investor experiences was actually a sense of maybe don't overthink it too much. While it's fascinating to dissect these differences, the reality is, for a long-term investor putting money away regularly, the performance difference between these two very similar, very good funds might end up being pretty marginal in the grand scheme of things. The cost of delaying your investment while you agonize over the absolute perfect choice could easily outweigh any tiny edge one fund might have over the other. That sentiment of just pick one you like and get started came through loud and clear. Acting early matters.
So we've really peeled back the layers on these global ETFs today, haven't we? Looking beyond the surface fees at the real costs, the hidden tax advantages of VWCE and FWRA. We've seen how tiny differences can lead to different tracking outcomes and how investors wrestle with that age-old tension, consistency versus maybe grabbing a bit more performance.
Yeah, and I think this deep dive really underscores something important. Being truly informed isn't just about the headline numbers, like the OCF. It's about understanding the mechanics underneath, like how that withholding tax actually works and affects your potential return. It makes you think a bit more critically about what passive investing even means when these nuances exist.
Absolutely. So maybe the final thought for you listening is this. When you're looking at any investment, how much do you personally value rock-solid predictability versus the chance of some extra performance, especially if that extra bit comes from something like tax efficiency, not necessarily manager skill? What's the price you put on peace of mind versus chasing every last basis point? It's more than just numbers. It's about your own investment philosophy, isn't it?